Hello traders, this is John Kickleiter, Chief Strategist for dailyfx.com, here with a Forex strategy video in which I want to combine a few concepts that we've talked about in this series over the past few weeks. Namely, I want to look at interest rate expectations and how it can be used to fundamentally evaluate whether a currency is over or undervalued, as it will be in this case, and how we can use that as a potential guide for medium-term expectations for currency prices. Now, I am specifically looking at the balance between interest rate forecasts on the Australian dollar and New Zealand dollar. Now, these two currencies have, first and foremost, the highest rate of return in the market in current rates. They also happen to have some of the best interest rate forecasts, yet their performance does not necessarily reflect this positive implication. Is this a long-term breakdown of conditions? Not necessarily, but we have seen these kind of conditions deviate in the past, and ultimately they do return to a normal correlation, so something to keep in mind. So I want to start off our conversation today with the New Zealand dollar. Now, the New Zealand dollar, US dollar, as you can see here, this currency pair has a pretty steady decline, though it's more congestive than a straightforward drop. Now, of course, the US dollar has been doing pretty well. And that is due to individual performance on interest rate expectations and kind of a disassociation to risk trends. However, when we're talking about what really drives fundamental traders and really drives the bulk of capital, it is the prospect for return and the current level of return in the markets. All right, there is no two ways about it. In fact, that's what has been driving carry trades like the yen crosses, and that has also been what has been driving benchmarks like U.S. equity indexes. Here you see the S&P 500. Yet we see this performance, risk appetite trends, a appetite for yield, and yet we see a clear deviation in that fundamental bearing and the performance of the New Zealand dollar. Not just the New Zealand dollar US dollar pairing, but the New Zealand dollar yen, Kiwi yen does not show any progress towards that large fundamental theme. And I think a very interesting one we talked about yesterday, the pound Kiwi. All right, Euro Kiwi, Aussie Kiwi to a certain extent. All the Kiwi pairs can be measured along these same lines, but I want to look at the fundamentals here. This is a relationship between the New Zealand dollar US dollar pairing and the 12-month interest rate forecast differential between the RBNZ and the Federal Reserve. As you can see, historically, the correlation is actually quite good, all until we had that decline between April and August, and the current deviation is actually quite substantial as well, with the exchange rate dropping and the yield forecast rising pretty quickly. In fact, the New Zealand 12-month interest rate forecast is at the highest level we've seen in quite a long time, pricing in nearly 107 basis points worth of hikes over the coming 12 months. Now, I can tell you, no other major central bank is anywhere close to that. Nowhere close. And yet we still see this deviation. My posit is that this is going to be a fundamental deviation that doesn't last for long. It will eventually close. And given the conditions for interest rate expectations and how consistent they are, they're not something that changes with the wind. This is something that has a established fundamental theme behind it. It's more likely that the exchange rate is going to catch up to the yield forecast. That is, unless we have a dramatic drop in risk appetite trends. If we have a dramatic drop in risk appetite trends, which I have always kept the door open to, I think it has a great potential. All right, but the probability has proven itself to be quite low because it does not play through. We also know that we are heading into the final month of the trading year, and that is a period that is typically quiet and positive for risk trends. So, if we are going to expect a medium-term reconciliation between this fundamental gap, it is more likely to be the exchange rate that catches up with the interest rate expectations as people seek out yield due to the slow risk volatility or the low risk volatility. And of course, if you're looking at other pairings, I also have seen the Euro Kiwi. I showed you the Euro or the Pound Kiwi, but looking at the Euro Kiwi, you can see another situation that is quite similar to actually what the Pound Kiwi offers. And this has been a pretty substantial rise. But when you look at the actual performance of the yield forecast, look how dramatic that is. I point out the Euro Kiwi specifically because the Euro interest rate forecast has been amongst the worst as of recent. That's because the ECB unexpectedly cut its interest rates at the last rate decision. We do have an interest rate decision from the ECB for next week. So there is a nice combination of factors here that is likely to see, or if we see that fundamental closure between fundamentals and the exchange rates, where they are on divergent paths, this is going to be one that has more amplitude to that move, a more aggressive correction. But it's not just the New Zealand dollar that has this potential. As I said, the New Zealand dollar is by far the best yield and the best yield forecast. Now, a lot of that has been subsequently thereby priced in. All right, we're talking about over 4.25% rate hikes over the coming 12 months. That's a lot of expectation. But there's still an underappreciation of the Australian dollar and what the interest rate forecast is going to be there. We still are expecting essentially no rate hikes from the RBA in the coming 12 months according to swaps, and yet it is more likely that they hike rather than cut net through the coming 12 months. Right. There might be an off possibility that they cut one more time, but looking out over 12 months and given the activity level, the ability to move quickly by the RBA, it's more likely that they see a rate hike. And that's something that's not necessarily priced into interest rate swaps and thereby the Australian dollar. Here we have the Aussie USD versus the RBA rate outlook. All right, and as you can see, this has been a substantial deviation, even more so than the RB&Z forecast. Now, if this starts to return to positive interest rate territory, significantly positive interest rate territory, there is a great possibility here. Just seeing the possibility of a rate cut or hike and the market starting to appreciate that possibility is going to be something that is considered a substantial shift in potential for the Australian dollar. We will see pairs like the Aussie USD, which has deviated from that gap substantially. We'll start to see a possible turnaround as well. Now, you also have to appreciate risk trends just like they do the RB&Z and the New Zealand dollar. So what I did was I actually made a fundamental measure. Where in history have we seen conditions where the S&P 500 as a measure of risk, so risk trends, where is it above its 20-day moving average, so essentially a 1-month moving average, but where also have we seen the 12-month interest rate forecast above its 1-month moving average, 20-day moving average? All right? When those two are both rising and rising above their 20-day moving averages, I would presume that that would be a positive indication for the Australian dollar, because interest rate expectations are improving, risk appetite trends are improving, and thereby we'd expect the Australian dollar to improve. I also have on this measure a reading of when there is a drop or the S&P 500 is below its 20-day moving average and the 12-month interest rate forecast is below its own 20-day moving average. Right? So it culminates in this indicator here. And as you can see, during these bullish fundamental periods where it's indicated in green and the bearish when it's indicated in red, this fundamental measure works beautifully. That is until we have this situation in May and the current situation we see here. Now, if we look at this in historical context, we can see that most of the time it works. Most of the time, this is a strong correlation. Right? It just happens to be a breakdown or deviation from that correlation now. But what are we supposed to take this as? Is this a sign that the historical fundamental drive, and the primary drive of this exchange rate, of this currency, is forever diminished? Or is this a temporary situation where we'll ultimately see a correction to that norm? I think that the latter is more likely. And that provides us a medium-term opportunity. That does not necessarily mean that it's now time to call a bottom on the Aussie dollar and see it just reverse from here. All right, this is medium-term, and we have seen some deviation. Substantially, this move was very much against the fundamentals that we saw. However, it ultimately would come back into a positive relationship. So as long as we see risk trends positive and interest rate forecasts improving in the Aussie dollar's favor, this is going to be an opportunity. And with that knowledge, we can start looking for entry opportunities, perhaps looking for something along the lines of a technical break, the first step being a reversal from a 6-day decline from the Aussie USD, though these are not necessarily conditions to go long a medium-term swing, as we discussed yesterday about trading during Thanksgiving or holiday conditions, which is not very good, not very conducive for these kind of setups. But once we see those other elements add up to a better trade opportunity, then we can start taking setups. Right? So I'm going to be looking at Aussie dollar, I'm going to be looking at Euro Aussie, and I'm absolutely going to be looking at the Aussie yen, which the yield forecasts on the Aussie yen and Euro Aussie specifically are very, very much ready to favor the Australian dollar. They are already favorable for the Australian dollar, and we are moving against that theme. But any kind of indication that there's going to be a rate hike within the coming 12 to 18 months from the RBA, which is a very high probability, but when the market starts to appreciate that fact, there's going to be a lot of room for these markets to move. Right? So keep this in mind as you look at these pairs, or as you look at the Kiwi-based pairs, like the Kiwi dollar, or like the Euro Kiwi, or the Pound Kiwi, which is right now knocking its head on a multi-year trend line and multi-year fib. All right? A lot of opportunity here if we're looking at what really matters to the market. Interest rates or yield, and the forecast for those yields. Right? Now, this doesn't necessarily have to correct immediately, but it does offer us a medium-term guide that once we see the technicals confirm what the fundamentals are telling us, we have good trade opportunities. All right? So keep this in mind for your medium-term setups, and keep it in mind if you are trying to even place short-term swing trades, perhaps against the current or with the current. All right? Particularly with the Australian dollar and New Zealand dollar, which are great opportunities. Good luck trading out there, guys. I'll do another Forex strategy video for the weekend tomorrow.